Many of my clients have been asking me about the 100% depreciation that just came through with the one big beautiful bill. Um, and I understand it can be somewhat confusing, and there's a lot of misconceptions there. So in today's video, I'm going to do a breakdown of what you should know and what you should avoid about the depreciation, which can be a very, very good tool for your business, but it's something that you have to consider and take a strategy, do it in a strategic way, because it's definitely not an open blanket that it fits for everyone. So does that mean that I can write off a vehicle or equipment? Yes and no. That's the answer, and that's what I want to get to in today's video. Sort of a 30,000 feet view of the whole thing, so that at least you have some idea of what to look for, and perhaps even avoid just going to the dealership today thinking that you can go in and buy a vehicle and that you'll be able to expense it right away. So that will be my goal, so that you at least understand what's on the bill, what's not on the bill, what you can expense, what you should consider when you're strategizing the depreciation that was given to us with the big beautiful bill. So hi everyone, my name is Julian. I'm a founding member here at Upfront CPA, and I've been doing this for over 20 years. And basically what I do is I help my businesses, my clients, the business owners, investors that I work with, to keep more of what they earn while they stay IRS compliant. So today's topic, the depreciation. So why are we talking about depreciation? Depreciation is important, and just to give you some background, before 2023, business owners could take 100% depreciation of qualifying assets. Very important, qualifying assets. That's equipment, vehicles, machinery, even certain buildings that you could, even some improvements that you did on, like let's say you own a building, or some type of investment, even some improvements you could fully depreciate on year one. Okay, year one, very important, because what happens? The IRS allows you to take the expense of the useful life of these equipments or these assets, right? But what happens is, in accounting, you're supposed to take the expense for the time and period that it earns it, if we can call it that. So basically, if a vehicle lasts, let's say, 7 years, so you're supposed to split that expense for the purchase, not for the daily use, but for the purchase. You get to expense it for the time that the vehicle is allowed to, that it normally lasts, right? So the IRS has a list and has a very specific timing that they allowed for whatever the type of asset that we're discussing here. And for that, just if you want to, just reach out to me, and I'll be able to provide you that list. That we're not going to go through every single one on this video, but something that you could perhaps look into if your accountant is not talking to you already, because it's something that you should be discussing with your CPA for sure. So in 2023, the percentage in 2023, after the big beautiful bill that just passed here in 2025, now things are changing. Okay, so why are they changing? Because what happened is, as I discussed previously, in 2023, before then we had the 100% depreciation. But what happened is, when they passed that law, at first that was supposed to be winding down, meaning it went from 100% to 80% to 60%, and that's where we are now. I believe there was the latest was a 60% that you get to depreciate on year one on certain vehicles. Not all vehicles, but certain ones. You were only allowed to depreciate 60% on year one, and this is important because if you're not like keeping up with the updates and the law and the reforms, you might think that you get to expense the vehicle on year one. And I just cannot stress this enough, because I have clients calling me, hey, I just bought the vehicle, and now it's up to you to depreciate it. And here at a CPA, we're supposed to follow the law, and we should not be giving you, or your accountant should not be giving you the wrong advice. So certainly, like I do, they should be looking how they can help you, but that you stay compliant and you're doing within what the law allows. Because the biggest thing that you want to avoid is the IRS to audit you and then have to pay money back because of just simply not getting the law correct. So now, thanks to the big beautiful bill, 100% figure is back and is returning to certain assets. Okay, it's not a blanket. It's not an open blanket that all the vehicles and all the equipment and all the assets get 100%. This is important. There's still certain restrictions that you have to follow through, and depending on the type of vehicle, depends on the size of the vehicle, the weight, then you might be able to take that 100% depreciation that first year. And even then, you have to strategize and consider that 100% depreciation on year one may not be the best strategy for you. It all depends on everything that's happening besides that, right? It depends on your net income. It depends on how much you're generating in other expenses. So it's something that you want to strategize. It's something that you want to plan and have advice ahead of time, so when it comes to doing your taxes, then you know and you have the backup to have done it correctly. So what is the 100% depreciation? What does that mean? 100% depreciation means that you get to deduct it on year one, like I said. So let's say you go in and buy a vehicle and it's a $50,000 cost, what it costs you. Even if you finance it, it doesn't matter. It's the cost of the vehicle. So what the depreciation does, and 100% depreciation does, is you'll be able to deduct the whole $50,000 that you spent on year one. Now, that depreciation expense is not supposed to take you to a loss. So if you made, $20,000 in net income on year one, and you take a $50,000 depreciation, they were only allowed to take the 20 because you're not supposed to bring that depreciation to a negative loss. Right, so that's another thing that you should be looking out. So that another important thing that you should be considering, and that your accountant should be talking to you, is the personal versus business split, and that this is very important. So if you're using your vehicle as for your business, but you're also splitting it with the personal use, you have to consider the depreciation only for the business use. This is not a personal deduction. This is a business deduction, and it's something that you need to consider. Okay? Another thing that you need to consider, and that is also very important, is the timing. Because it's the timing is when you deliver it, when the vehicle is delivered, not when it's bought. So let's say you bought it, and this is something you should be looking out if you're looking at buying the vehicle towards the end of the year. Because remember, not all the vehicles are at the lot. Some people like to go in and buy the vehicle, but the vehicle's not there, and they might need to deliver it from someplace else. We've been seeing that a lot lately. So if you're buying the vehicle towards the end of the year, and you're gonna have it, they don't have it in the lot. You're supposed to have it delivered because you have it customized, whatever the cost may be. It goes over the next year. When it actually gets delivered, then the depreciation does not account until the following year. Also, another thing that you need to look out is this is only for property within the USA. If you're looking at properties foreign, and this is important for foreign investors, if you're looking at foreign assets, depreciation is not allowed, and there is a very specific code. I believe it's a section 168 where it specifically says that that properties outside of the U.S. are excluded. So something important to look at. Okay, so next I want to talk about the most common misconceptions. Mostly what I want to mix this with what I get with my clients is, does any vehicle qualify? Wrong. Not every vehicle qualifies. So there's still that 6,000 pound famous rule that still applies. What does that mean? That means that if your vehicle is over 6,000 pounds, then yes, you can depreciate 100% of the vehicle generally, because even then there's some exceptions. But how we're talking about here in sort of like general terms, it's still like if your vehicle is over 6,000 pounds, you can still get 100% of the depreciation on year one. However, if in the other case, if it's under 600 pounds, it's considered a luxury vehicle, and because of that, you only get a $20,200 is the most that you can depreciate on year one. So as you can see, you still got some room there. You still got some strategies that you can work with, but this is important. So if your vehicle is under 6,000 pounds, it's considered a luxury vehicle. You don't get to expense the whole thing on year one. You can still depreciate it. You can still work some strategies out, but you cannot take that full depreciation on year one. Okay, so only heavy vehicles. That's something important to remember when you're talking about the full depreciation on year one. So another misconception: 100% means full deduction, right? Well, not always, and this is where it gets confusing. When you're talking to, I've had clients that told me, okay, yeah, no, I saw a video on YouTube. My brother's CPA told him that he gets 100% depreciation. So this is where it gets tricky, because 100% depreciation doesn't mean that you get to expense the whole thing. This goes back to what I just mentioned, that under the 6,000 pound rule, you only get the 20,200 limit. So what your CPA or what they might mean to say is that your 100% depreciation is for the allowable amount of 20,200. So that's where it gets confusing, and where you need to look out and make sure that you're talking to an expert that really helps you, right? That really understand what's going on. So let me just give you an example. Let's say you buy a $50,000 truck, right? There's 100%. Is it 100? Let's say it's 100% use. Then it's 6,000 pounds. You get to spend the whole $50,000 on year one. So let's say it's 70% use for business, 30% use for personal. Then you only get to deduct which will be around $35,000 that you get to depreciate your max because of the percentage of your business use. So now let's talk about Section 179. So I get asked this a lot. What is Section 179? So Section 179 is another depreciation, let's say, method that it's available for businesses. It's when they create these laws, you have Section 179, you have full depreciation. These are all techniques and laws that have been passed throughout the years to help business owners take deductions and to incentivize the economy. So 179 allows you to also take some depreciation that you can combine with your regular depreciation or your bonus depreciation. When it doesn't allow, then you can use Section 179 that you can apply to certain properties that bonus doesn't. So that's really when it comes to like non-residential improvements, stuff like that. You can still use Section 179. I'm gonna do a whole video about this Section 179 because it's a very, very important topic and one that you want to listen to. But today we're talking about just depreciation, and it'll take a lot of time to combine the 179, but it's something that you should be talking to your accountant, especially if you own real estate and you have non-residential investments. So let's do a debrief here. I've thrown a lot at you, and it's important that you at least understand what's going on, because you're not an accountant, you're not a CPA, or you may be. And you do want to make sure that you stay within your that you understand what's going on, that you give the right advice to your clients, that you help them stay compliant, especially on this year. And this year is key because the big beautiful bill just passed. I've seen a lot of YouTube videos where this 100% depreciation gets thrown out a lot out there. So a lot of my clients just come to me, and one just called me a few days ago and say, I'm on my way to the dealership and buy my vehicle, and just to give you a heads up because you're gonna be depreciating it on year one. So this is where I had to do this whole explanation to make sure they understand where they're getting to ahead of time. This is like very high level, but I think I've given you the at least the foundation to understand what's going on. Here at Upfront CPA, we've been working with clients to save taxes, to make sure they stay compliant for a long time. We're experts on a small business, medium-sized business. If you're doing a startup and you want to get a consultation, you want to see, you want to know, and this is important because what a lot of businesses fall into a trap is that they start everything on their own, or whatever their brother, their cousin, their family member told them. And they kind of follow their advice, and they don't always start up in the right foot, and it can potentially be very, very costly, to the point where it may prevent you from actually starting your business and be able to scale it, to be able to have it in a way where it supports you and your family. So if you're starting your own business, start it the right way. Do a consultation. All of these, even if you do a small fee consultation, it'll be worth not spending that money, because you're gonna be spending a lot more down the road just because you didn't do things the right way. You don't have to call me, but there are plenty of CPAs out there and good accountants that can help you. Well, I hope you found this video helpful, and if you were looking for more content, follow us on YouTube, and we'll be coming back with you.